Hi everyone, and welcome to this special edition of HUBsights, where we're lucky to have Vimal Gor from Pendle Group here with us. I'm Anne McDonald, the Head of Marketing here at Hub24. So just a few housekeeping items for those of you who haven't joined us before. The lines will remain muted throughout the presentation to prevent any background noise. So if you have any questions, please use the webinar control panel and send them through to our team. At the end of the webinar, we'll be having a Q&A session, so any questions that are raised through the webinar, we will cover at the end of the session. And so, without much further ado, I'll hand over to Vimal, who's going to be talking to us about debt reaching new peaks.
Hi there, and thank you for inviting me to speak today. I want to talk about debt levels. Anyone who's seen me present the last few years will know I always use the phrase, the world can't handle higher interest rates. So today I want to take you through exactly why that is. I'd like to start with a little bit of a recap of what's been happening this year in the markets. We saw a lot of volatility in early February, so I'll quickly touch on that. And I'll take you through some of the debt dynamics we're seeing across the world, focusing specifically on the US and Australia, but then bringing it into a global context. And then finally, I'll try and wrap it together with how potentially you can navigate these more turbulent times. So if we just move on to the first slide, you can see here that the market has experienced a large drawdown in early February of this year. You can see that it had a very strong run up in January. The market got to very stretched levels on virtually every technical indicator you care to look at, and then we saw a sharp correction. What was really interesting about this correction is it hit the 200-day moving average, which is generally a very strong level of support, and it bounced from there. Since then, it's come back and retested that 200-day moving average a number of times. Our belief is that while the level is still quite strong on the S&P and the market stayed trading reasonably high, then we're in a medium-term topping process. And when we trade through that low that we saw in February, which is just below 2550 on the S&P, the market will likely capitulate into that. So we're not saying that we're expecting a large drawdown, but we are saying that we're expecting a high levels of volatility going forward. And as you'll see later, that's going to be a recurring theme through the presentation. But generally, we saw a bit of a drawdown. We've recovered since then, but our belief is that we're medium-term topping on risk assets. The second slide is really interesting. If you can see here, what we've done is taken the returns in both bond yields and S&P over the last few years. Sorry, just going back one. And you can see there's a negative correlation. And if you take the long run correlation between bonds and equities, so you take the 10-year rolling correlation over the last 100 years, there's actually no discernible correlation. It's 0.01. But the last few years have been characterized by a negative correlation between bonds and equities. So that's the basic building block of a broader balanced portfolio, that if your equities are selling off, your fixed income protects you. What's been happening this year, and you can see from the slightly orangey yellow line 2018, that the correlation shifted. And that's because we're coming out of this period where all asset classes were driven up in valuation terms by quantitative easing. So what's happening now is the bond yields are selling off, and that's feeding back into equity markets that people are worried about the level of discount rates, and then that backup in equities is leading into credit. So you're pretty much seeing all asset classes selling off together. And you saw all asset classes rally for the last 5 to 7 years, so for them to see them all to sell off together kind of makes sense as well. So up until, well, certainly up until now, for this year, you haven't really been able to rely on fixed income to protect you in the same way you would have done previously. Our view is that that is changing now, and fixed income are moving back to their position as a defensive asset class again, and I'll build on this theme as we go through the presentation. So now I'd like to run you through the debt metrics and to get a full understanding of how we're seeing the debt build up across the world. Okay. On this slide, we can see that since the GFC, total debt in the world has actually increased. And we've gone from 215 to 245% of world GDP since the GFC. Now, there was only really one sector across the world that delevered post the GFC, and that was the US household sector as they walked away from mortgage debt, but they were pretty soon re-liquefied by the governments. And then since then, you've seen all sectors across all countries beginning to increase their leverage again. This is really due to a combination of quantitative easing, ultra low rates, a big re-leveraging of corporate balance sheets, really specifically in the US, populist governments, and a return to consumerism. When you look across the right, you can see this debt build-up has been across all countries, but the majority of the debt increases have been in China and the US. We expect this increase in debt to continue as China depends on debt for investment, which is needed to drive GDP growth. So while China is shifting its GDP model away from fixed asset investment into consumption, we believe that till that transition has been fully enacted, that any growth in GDP will largely be investment and fixed asset driven and therefore debt driven. And so while the deleveraging and the shift in the leverage levels in the Chinese balance sheet are going to happen over the long run, we don't believe that happen now and unlikely to make a material difference to the debt levels over the next couple of years. The US debt picture worsens quite dramatically, though, as I'll show you on the next slide, and this is really the result of the recent changes to policy in the US with rising fiscal deficits in focus and Trump achieving his goals on tax reform that were enacted late last year and the removal of the debt ceiling as a medium-term issue. These two initiatives will drive the US fiscal deficit from 3.5% to 7.5% of GDP at its worst. This next chart really just puts the US debt situation in perspective. What we've got here is we've put the presidents and the decades on the bottom, and I just want you to stop for a second and take a look at how bad these debt levels are getting in the US over the next few years. You've got to remember as well that we're currently in peacetime, and this is the second longest expansion in US history. According to CBO projections, the US government debt outstanding will reach 30 trillion in 10 years' time, up from only 5 trillion 10 years ago. This increase in debt isn't just worrying from the point of view of financial stability. More debt puts a natural cap on how high interest rates can go. And we can illustrate this with forecasts of US interest payments under some different scenarios. What we've got here is US net interest spending over the last 50 years. And that's the dark blue line. And what we can do is we can project it using the CBO forecast. So the light blue line at the bottom was using the CBO forecast in 2016 when the CBO did their projections using the prevailing interest rates or bond yields at that time. We can see here that the net interest cost remains about 1.5% of GDP. The second line shows you how material the impact has been of the tax changes we've seen in the US. And so now we're using the forecasts from the CBO of this year, which account for the increase in the budget deficit. And you could see that the net interest expenses shift up from 1.5% to about 3% of GDP. And this is a direct drag on the economy. And finally, the really scary outcome, and we don't expect this to happen, but if bond yields were to rise another 1.5% to take the 10-year Treasury yield to 4.5%, interest spend increases to 4.5% of GDP. This is a really worrying situation because you get into a vicious circle. Effectively, what happens is the more you spend on interest expenses as a percentage of GDP, the more that your creditworthiness is called into question, the higher interest rates go, and therefore the more you spend on interest expenses, etc., etc., etc. So there is a direct impact on how much you spend to your borrowing costs, and also using the Rogoff and Reinhardt analysis that the market's very familiar with and that was everyone was talking about a few years ago. As your debt levels increase, they impinge on your levels of GDP growth. So the US is skirting into a situation where it doesn't really want to be in now. It's going to have to sell a lot more bonds over the coming few years. And this is the crucial thing, and I'll come back to this a number of times in this presentation. The US has to sell this year about $1.4 trillion worth of bonds. That's for the sales plus what they're doing in quantitative tightening. This is double what they did last year. And that's why you're seeing this liquidity issue happen across the world in low-grade investments, because there's this big sucking sound as money leaves speculative investments and comes back to US Treasuries. And let me talk on that in depth a little bit further. But just finally on this chart, you might not be worried about these interest expenses. They're only slightly higher than we saw in the 80s on that middle line, projected orange line at 2018. But the economy was growing very differently. Back then, the economy was growing at 8% with 10% 10-year bond yields. Today, we're going at 3% with 3-year bond yields. High interest payments are fine if the economy is growing quickly, but the ability to pay those interest costs is diminished rapidly. Clearly, the higher rates go, the more the economy will slow, and we're beginning to see that in the US now. All the leading indicators are telling us the US economy is coming off the ball. This effect is ultimately debilitating, but in our view, rates are already too high. Now moving to Australia, everyone knows how high debt levels are here, especially at the household level, with mortgage debt being the main driver. The economy is doing okay in terms of growth, but high debt levels ensure that if interest rates rise at all, they won't rise far. This chart tracks the debt-to-income ratio for those households with an LVR equal to 80%. We've put a dotted line here, which is at the 30% level, which is generally accepted to be the level at which households enter mortgage stress. We were just above this point from 2004 to 2006 when mortgage rates were about 7%. But strong wage growth and house price growth at the time ensured it wasn't an issue. But currently, RBA cash rates are 1.5% and mortgage rates around 4%. You can see the households are already bumping up on that stress level. We've got three scenarios here where we model an interest rate hike of 0.5%, 2%, and 3.25%. The reason we've used 3.25% is that will take us back to the 7% mortgage rate levels we experienced in 2005. At this level of rate, debt-to-income ratios will be heading towards 45% at a time where there is very low wage growth in Australia. And that really illustrates the whole problem we have in Australia and arguably the world, as what's been happening is total debt levels have been going up, but because bond yields and interest costs have been coming down, the net interest payments or service affordability have been largely static. But now interest rates are going up across the world, it's squeezing these over-leveraged and over-indebted sectors of the economy. Low wage growth is so important for Australia because it's weighing on this ability to afford debt. And this insane level of debt in Australia means that wage growth is a necessity, i.e. we need to see wage growth before we could even entertain the idea that the RBA would hike rates. The availability of credit in terms of ease of access through declining lending quality has been highlighted by the Royal Commission. So what I want to do now is quickly take a trip back in time, looking at how the Australian financial system has evolved and understand why this is. I've picked Australia here because obviously our home market, but I could have used the illustration of the Australia, US, UK, Europe to show this break and increase in leverage pretty much across any economy because the drivers have largely been the same. So what we're showing here on the three lines are total loans and corporate bonds on the grey line, Aussie GDP in the blue line, and house prices in the black line. In the 70s, the borrower-lender relationship was dominated by the relationship with your bank manager. Unless you're a good borrower with years of reputation interaction, then you couldn't get money. This constrained credit growth roughly in line with the growth of the economy. The 80s came along, and along it with a greed is good environment, and we had Michael Milken, we had Wall Street, and we had all the big excesses that came in that period. And then Australia domestically, we had the Campbell report, which suggested deregulation of the banking system. The first effect of this was this entrance of foreign banks into Australia. They had a lot of money and they wanted to lend a lot of it. This caused a corporate lending boom and a lot of money was borrowed for clearly bad decisions. But not only was it borrowed on the corporate side, it leaked through into household lending, and mortgage lending also increased. That saw the first driving of credit growth and house prices, where they started accelerating faster than economic growth. The recession in the early 90s hit our banks hard, with some nearly collapsing. This resulted in a consolidation, a theme that would continue, and we began to see our banks being upgraded in terms of their credit rating. The key change, though, happened in the late 90s with the entrance of the mortgage broker, introducing one more degree of separation between borrowers and lenders. As Charlie Munger of Berkshire Hathaway said, "When you show me the incentives, I'll show you the outcomes." When you introduce degrees of separation between people lending money and borrowing money, you get arguably bad behaviours, and that's what the Royal Commission is highlighting right now. And a lot of these bad behaviours and easy credit led to house pricing and credit growth exploding. This trend continued into the 2000s. The banks got bigger and bigger and bigger, ensuring their access to capital overseas. But then we hit the GFC, and our banks looked so great relative to other banks across the world as the US and European banking system suffered hiccups with bad loans. And so Australian banks were able to access more money and higher levels of funding due to a higher credit rating, and the fact that the RBA, the regulators, are very proactive in supporting our banks during the GFC. To summarise, lending standards have fallen and have resulted in seriously negative outcomes, as credit growth and house prices have massively outpaced GDP growth. But as I mentioned, this kind of story isn't limited to the US or Australia. Excess credit growth is a direct result of too much liquidity sloshing around the global monetary system. We can see in this chart, when we look at the 5 central bank balance sheets, that they've been in excess, i.e. central banks are boosting liquidity 90% of the time since the 2000s. All is well when growth rates are high and arguably turning up, but when the impulse turns negative, it invariably results in economic mishaps. A few recent examples of the pulse turning negative, and the effects are 2006, which led to the GFC, 2010, the Euro crisis, 2013, oil crash, and 2015, China EM growth problems. As you can see on the the dots on the right-hand side of the chart, we're heading towards liquidity contraction by the end of this year. What does that mean? For us, it means that we're entering into a period of much higher volatility. You can see this chart, which shows central bank quantitative easing purchases versus the VIX. As the central banks unwind and the Fed is actively selling bonds back to the market via quantitative tightening, and the ECB and the BOJ do stealth tightening, that the pulse of purchases has turned, and we're going to be running negative in the latter half of 2018 and early 2019. As you can see, this change in pulse has correlated very well with increase in the VIX, and the VIX at 13 is still markedly low in our opinion and should trade materially higher over the next year or so. Volatility is back, and we strongly believe it will increase further. And it's very, very worrying for investors who are overextended out the risk curve. And many investors are, because the whole point of quantitative easing was to force you out the risk curve. As Ben Bernanke, chairman of the Federal Reserve, said at the time, it was about the portfolio rebalance effect. So effectively, the central banks drove interest rates down on government bonds to force you to sell government bonds into investment grade bonds, then into high yield bonds, then to equity bonds, then into EM equities, and so forth. They drove up the capital price on those asset classes and drove the yields down and pretty much equalized the yields and everything at very low levels. But Mervyn King, who is the Governor of Bank of England, said it was effectively bringing forward future asset class returns to today. So incrementally, over the last 8 to 9 years, people have been forced to extend out the risk curve. And that was fine while interest rates were low and going lower, but now central banks are pulling back and hiking interest rates. There are two key themes in our portfolios right now. The first is the everything bubble. We believe that all asset markets are overvalued and should back up. That's less so for the case for bonds, high quality government bonds, and I'll touch on that a little bit further in a minute. But generally, we believe that a lot of asset classes are at stretched valuations. And secondly, as you can see from these charts, the return of volatility. So if there's asset classes you really need to be concerned about, it's where you get volatility up against an asset class which is arguably very stretched in terms of valuation. And increasing volatility generally needs to lower liquidity as well. And this is a toxic mix for credit and emerging market securities, and we've seen in markets recently. For example, we've seen the meltdown that's happening in Turkey, where the dollar Turkish lira FX rate has moved over 30% in the last few months. We're beginning to see hiccups in a number of emerging markets. For example, the Malaysian ringgit moved 4% just the other day. And you can see the volatility we're seeing across equity markets, emerging markets, and also in Italy, where we've had a massive spread widening, where the Italy-Germany spread has moved from 130 to 230 basis points in the last few weeks. So these dislocations have only just started. And while any one of them you could argue is idiosyncratic in nature, we would argue that it's a result of this second chart. This chart here. The end of the TINA trade. There is no alternative. And you can see here there wasn't any alternative to equities for many, many years. And that's because the equity S&P dividend yield traded materially above the risk-free rate as with proxies with US bond yields and 3-month LIBOR levels. But that's changed. The interest rate increases we've seen in the US, coupled with the funding pressures we've seen across the world, have moved the cash-free rate above dividend yields in the US. So the front end of equity, the front end of fixed income, is now a decent investment option. And that's when I mention this sucking sound you're hearing from across the world. You've had 8 to 9 years of people disinvesting out of bonds and in going further and further out the risk curve and investing more and more money into high yield, cover-light, low-grade debt in emerging markets. And now, when treasury yields are backing up and the risk-free rate is a viable investment option, you're seeing that money beginning to come home. And we believe this is only the start of a multi-year deleveraging process, which will see bonds supported and performing well up against virtually every asset across the world. The time may not be just yet, but it is rapidly approaching, and when to buy bonds, long-term, high-quality government bonds, is a key question for us this year. So when the time is right to buy bonds and rely on the defensive part of your portfolio to protect you, you need to make sure that the manager you call is actually defensive. And I'd like to spend just a couple of minutes now running through 2 key products and 2 key funds that are specifically built to perform in this kind of environment. The first one is the Pendle Fixed Interest Fund, which is our flagship Australian composite vehicle. It's managed against the Bloomberg Composite Index, and unlike a lot of funds in this market, it uses alpha drivers, so duration yield curve, credit, cross-sector, currency, etc., to generate its returns, and it doesn't run a static overweight in credit beta, which we believe is going to come under pressure. The next chart shows how when you look at the index and the correlation to equities, that we are the most defensive manager in Australia. You can see these dots are all the other managers within the Morningstar peer group, and you see the Pendle dot, which is the yellow dot in the top left-hand quadrant. And we have the lowest correlation to equities of the peer group, and we're more negatively correlated to equities than the index, and we have the highest monthly return where equities are under pressure. So when the time comes and you need your fixed income assets to provide the insurance premium which you buy them for, where you can see we are clearly the most defensive manager in the peer group. The second product I just wanted to touch on very briefly is the Pendle Monthly Income Plus Funds. Income funds have become a very hot commodity over the last few years But when you look across the income funds in Australia, most of them are just credit funds which have been rebadged. And you can see on this next chart, when you look at the, in fact, can you go forward? We'll go forward one more chart and then come back. When you look at the correlation to global high yield, you can see that most of the income funds in Australia have a high correlation to global high yield, which means they're accessing credit beta, which doesn't make them bad funds, but you need to be aware of that when you get turbulence in equity markets and therefore credit markets. And there is a very high correlation between global high yield returns and equity target returns in times of equity market stress. You can see though the Pendle MIP fund, monthly income plus fund, has a very low correlation to global high yield, and its net return is slightly higher than the median fund for the market. And finally, if you just go back one slide to this slide, you can see it's achieved its two primary aims, which is about giving you monthly income every month and also protecting against inflation. And you can see over the last 7 years, it's returned 3% above the RBA cash benchmark. So that hopefully gives you an idea of how we're viewing fixed income here. While it was right to be defensive on fixed income and all asset classes over the last 6 months, fixed income is now backed up to a level which makes it look attractive against other asset classes. This means you have to consider it in two ways. Firstly is about you need to consider it for its defensive characteristics in your portfolio, and now as it trades on high yield, it's able to play that defensive negative correlation to equities roll again. And secondly, you need to think about how other asset classes respond to higher fixed income rates. Because remember, global government bonds are risk-free rates. And secondly, the US risk front end is the risk-free, global risk-free rate. And when that trades at a decent yield, it means that other assets come home. And I talked about the fact there's going to be $1.4 trillion of US Treasuries sold this year. Those bonds will be sold, there is no question, but the money for them has to come out of other asset classes. So bond yields selling off isn't that bad for bonds, but it's very bad for other asset classes. And that's why we fully believe that volatility is coming back, and you should be thinking about reintroducing bonds to your portfolio. And when you do that, you need to make sure you get a manager who is very clearly defensive.
Thanks, Vimal. We do have a few questions here for you. Firstly, what is your view on Australian growth and inflation?
We think Australian inflation is pretty much symmetric around 2%, and growth is it's okay, it's lackluster. The economy is reasonably balanced, but while it has no wage growth, we find it very difficult to envisage a situation where the RBA will be hiking rates. In terms of the RBA's own forecast, they don't anticipate inflation to come back into the above 2% to 2020, and that's quite a long way away. So far, RBA Governor Lowe has been for every meeting and not changed rates. We think there's a chance he'll be the only RBA governor in history who sees out his term without having to change rates at all.
Right. You spoke about mortgage stress increasing with the increasing interest rates. So what's your view on whether there's going to be an Australian house price crash?
We'd like to think and hope there isn't. The house market is very clearly coming off the boil. One of the recent changes that's come out of the Royal Commission is this focus on what they're classing liar loans, or the expense side of the balance sheet, where companies are, where the banks are much more focused on making sure the expenses side is right. Our estimations are when you move the expense side of a loan application to where it should be, as opposed to massaging the numbers down, as arguably a few brokers and loan applicants have done, it takes about 30 to 40% off the borrowing capacity. And so that's a real negative impact. Our base case is that house prices move sideways with within a slight depreciating trend over the next few years. But obviously, if we get big increases of volatility across the globe and equities show a lot more volatility, well, then there's an outside chance that house prices weaken up more. But obviously, the RBA is very alert to that, and it has to be one of their key risks on the horizon.
Absolutely. What is your view regarding hybrids, and what chance do you give the following outcome: higher mortgage rates and a lower RBA rate?
We don't invest in hybrids across my team because we don't believe they're fixed income securities. That doesn't mean that hybrids don't have a place within a broader balanced portfolio, but they need, in our view, they need to be funded out of the equity portion, and that's really because they act like an equity in the bad time and they act like a bond in the good times, i.e. they're negatively convex. So while there is a place for them, they shouldn't be held as part of your defensive portfolio. In terms of lower RBA rates and higher mortgage rates, I think that is certainly, it's a scenario that's possible but not probable. The banks would certainly like to be able to increase mortgage rates here because they're coming under pressure when their margins post the Royal Commission, but it's really about whether they're able to actually increase rates or not.
Given the recent moves in the oil price, what is your outlook?
We think the moves in the oil price are really largely geopolitical, and they're not to do with supply or demand. So really what's been happening in Iran, obviously where the US has reintroduced the sanctions and turned off the oil supply from Iran is a key factor, and also what's happening in Venezuela, that the government has problems and oil supply dwindles there. Our shorter term view, I've been reasonably bearish on oil prices for the last few years, but our short-term view is that oil prices have more potential to increase from here than decrease. But the key thing to think about in oil prices is we need to think about it and its impact on both sides of the economy. So firstly, higher oil prices will lead to higher inflation rates, and that's quite clear as they feed through to headline inflation. But the second thing to consider is they're effectively a tax on the consumer. And so higher oil prices lead to higher gasoline or petrol prices, which directly impacts the consumer's back pocket. And in the US, this is happening at the same time as mortgage rates are rising. So the consumer is being hit twice on what is already not particularly strong levels of consumption. So that's one of the reasons why we believe the growth levels in the US will slow from here as opposed to increase.
Great. Another question around real estate. It seems to be a popular choice today. The Australian real estate market has closely followed the Canadian market in terms of interest rates and growth. The interest rates have gone up to 7% and growth has eased significantly. Do you see the Australian market heading in the same direction? Yeah,
I think it's fair to say that the Canadian market and the Australian market have a lot of characteristics and a lot of similarities. And arguably, what's been driving both of the markets is immigration. The Canadian markets were the Australian markets on steroids. They had much larger immigration and a tighter housing market, and therefore their prices were driven much higher than ours. And obviously they're coming off the boil now and are falling quite rapidly. There's less of a swing factor in our immigration, but that said, the valuation levels in Australia are still quite high, and the affordability is worrying. So, as I mentioned, our base case is that house prices track sideways to a little bit lower over a few years. But if we had to pick a scenario against that, we think it's much more likely that they fall rather than rise strongly.
Okay, thank you. Just a question on inflation. Is inflation an issue now or in the future in the US, or is it debt issuance the driver of increased yields?
It's quite funny that if you look at the US is quite different to a lot of economies in terms of their economics, debt dynamics, and a few things, but inflation is the one where it really is different. So you can make a strong argument, and looking at the numbers, that you don't have a global inflation problem. The Indian numbers, the Chinese numbers, the European numbers are all rolling over and very weak. To give you an example, European inflation is at 0.7%, which is only marginally above the lows we hit during the GFC. But what you are seeing in the US is you are seeing the limits of capacity. So, what we're seeing is, from the earlier charts, is Trump is enacting a large fiscal stimulus at the same time as we're through the natural rate of unemployment and we're through the output gap. So this has to be inflationary. So we're hearing anecdotes, and across virtually all the wage numbers, we're seeing wages pick up, which is beginning to feed through in inflation. So our belief is the US potentially has a problem in inflation, but nowhere else in the world does. And that's why we believe that the front end of the curve will continue to sell off. And as the front end of the curve continues to sell off, it again drives those yields up in the front end and causes problems for the rest of the world. In terms of the debt dynamics, the US debt dynamics are way worse than everyone else. And I would be surprised where they continue to increase their quantitative tightening program as they have currently planned, and they plan to increase it every quarter. We'd be surprised were they able to do so because the ramifications of that are only being felt in markets now.
Great, and just one final question. The Aussie dollar has recently fallen against the US dollar. Do you think this will continue?
For us, the Aussie against the US is really a byproduct of what's happening around the US dollar. So we saw a large, so if you just break the period really since Trump into a number of different time horizons, you can get an understanding of what's happening. So the first one is when Trump was first elected, the belief was that interest rates would go up quicker and the US dollar rallied strongly. And then you came through a few months after that, people started beginning to lose confidence in the Trump agenda, and the dollar started depreciating. Then Trump enacted the tax reforms and the spending cap changes, and the market began to worry about the twin deficits, which saw the dollar weaken up further. Since then, in just the last couple of months, the market got itself very short dollars, US dollars, and this rise in interest rates is beginning to see interest rate differentials coming back to the fore, and this money I've been talking about is coming back to US dollars, driving US dollars up. So when you look at Australian FX rates on a trade-weighted basis, we're not really moving much, which tells you it's purely about the US dollar moving and everything else moving roughly in line. And so we would believe that's going to continue over the short to medium term. In the long run, though, we are reasonably positive on Australia as an idiosyncratic story over, say, the next 5 years. And that's to do about how we're transitioning our economy towards the more service sector, which are tourism and education.
Great, thank you. Well, I think we'll wrap up there. Thanks very much, Vimal, for joining us today. And anybody on the phones, if you would like to get in contact with the Pendle Group, then please drop us an email or have a chat to your BDM, and then I'd be pleased to put in touch. Keep an eye out for our next HUBsights webinar next month. Thank you.
Thank you.